Valuations don't tell you anything about what stocks are going to do in the next 3, 6, 9, 12 months, or even 5 years. In fact, one of the best investment strategies looking in the rearview mirror that you could have employed over the last 5 years was to own the most expensive stocks in the market. So I could look at a PE ratio and tell you it makes me feel good or bad or a little doubtful or a little nervous, but honestly, it's junk science at best. There is nothing there. There's no signal. Most of what's gone on in the last 12 years really has more to do with where interest rates are, what liquidity looks like, and the way people invest. And nowadays, people are investing based on asset allocation. So we have these corrections, and they used to last 6 months or 9 months and get out of hand. But the recent history is that those corrections are bought really quickly by wealth management firms, taking trillions of dollars and just adding to whatever ETFs drop the most. And as long as we're in this position of liquidity and the wealth management business model subsuming the old brokerage commission-based transaction model, I just don't see what the catalyst for that to change would be. We had $100 in S&P earnings last year. You know what we're going to earn this year on the S&P? Close to $200. So people are like, ooh, valuations are high. Well, where should they be? What should the market be doing? You're gonna see $175 to $200 in S&P 500 earnings, 6% GDP growth, no interest rate hikes. You tell me where you think the S&P should be.
Right.
You throw your dart, I'll throw mine.
But obviously valuations take into account the E because it's a multiple we're talking about. But Josh, at what point over the last 5 years did you conclude that valuations are junk science? Is this something that you concluded 2, 3, 4 years ago and have enjoyed the ride up, or is it a more recent realization that you're now scrapping valuation as even a small input to your view over the next 5 or 10 years?
I think valuation matters more in the extremes. There are companies right now trading 50 times sales. They won't stay there. They're going to get hurt. They'll get hurt the first time there's an earnings disappointment that the shareholder base chooses to pay attention to. We got a little taste of what that looks like with a couple of the SaaS names in the last earnings go round. I was on the show the night Fastly blew up. The stock's mostly recovered, but like it's brutal if you have a big position on in a name that has no valuation support at all. So the point is not that valuation doesn't matter. It's that it's a terrible guide to forward returns. And to a large extent, the markets have gotten smarter. The markets have been pricing names like Salesforce and Netflix and Tesla at higher and higher valuations, but that's been going on for a decade, and the markets have been right to do that. These companies are compounding revenue, net income, pick your metric. These companies have been compounding at a rate of 5 to 10 times the overall S&P. Why wouldn't they be expensive stocks? And things get expensive because a lot of people want to own them. So if you agree with that premise that markets aren't always dopey, like that there's some intelligence involved, and you see this whole cohort of stocks trading an above average multiple, your knee-jerk reaction shouldn't be they're wrong. It should be curiosity. Why? Why does this group of stocks get a persistently higher multiple than Campbell's Soup? There must be some rhyme or reason. So I think a little bit of humility and not this knee-jerk, what's the PE ratio, it's expensive attitude, probably helps you more than hurts you.
Shepard Smith here. Thanks for watching CNBC on YouTube.